Let's bring in top venture capitalist now, Rashaun Williams. Welcome back. It's nice to see you and Happy New Year.
Hey, Happy New Year. Good to see you.
So there was a lot of optimism, obviously, coming into 2025 about a rebirth of IPOs, animal spirits and all of that, which we talked about several times over the course of 24. Do you think that was unfounded optimism?
You know, I don't think so. There's so many things that have to go right for the tech IPO space to open back up. All of these things have to align perfectly. And unfortunately, they didn't. So we still have to hold on to it because so much is riding on it. Although I will say the secondary market, which was a stepchild to primary market liquidity events a few years ago, is really creating liquidity for VCs and founders and employees. And there's so much funding in the private market. Guys just have a war chest of capital to last through this kind of downturn on the tech IPO side.
What's the most interesting thing to you right now in your world of the capital that you have and where you're trying to deploy it? What seems to be the most interesting thing to you these days?
I'll tell you, I've never felt more popular as an alternative investment manager than I have in the last 12 months. I was just listening to some of the other folks on your show, and everyone's allocating alternatives as a core part of their portfolios now. And we've been kind of playing that drum for a long time. There are two things that everyone's talking about in my world. You just talked about it with late stage AI companies. So late stage tech, specifically AI and cyber, driving activity in my personal portfolio and in our funds. And then sports teams. You already know it's a non-correlated or low correlated asset class or reoccurring cash flow, trading at revenue multiples, just like software companies were 5 or 6 years ago. And those two asset classes are generating the most interest with investment advisors and with retail investors that I'm seeing in several years.
I mean, you're an LP with the Falcons. Let's just, get that out there. We've mentioned it many times, but just so people remember, your pullover notwithstanding, your quarter zip that I noticed, you have the logo on yet again. But do you see an endless runway for valuations in sports? And do you think at some point it gets into bubble-like territory? I mean, how do you view it when now seemingly, as you just referenced yourself, everybody's talking about it?
Yeah, this is the same conversation I had 8 years ago about late stage tech. Remember when there were only 4 companies that were valued over $1 billion and none of them were profitable and everyone kept calling it a bubble? And now we have $1 trillion companies and over 100 companies that are valued over $1 billion. And we created a whole term for it called unicorns. We're kind of in that space with sports franchises. What's the key to this whole equation is not the valuations. I know it's going to sound crazy. It's revenue. So revenue is driving valuations. The multiples are staying the same. All the revenue is coming from national media rights. So the streamers and the media companies are all paying these sports teams because the top 80 to 90 of the television broadcasts are all live sports events and politics, right? So it's driving all of the viewership, which is driving these big mega deals that you just saw with the NBA, which is increasing revenue. And these are 10-year deals. So if I'm an investor and I'm looking at a stream of cash flow with a tier 1 creditor that is not correlated to the stock market and is kind of exciting, I want to have my assets in some type of basketball, baseball, or football club if I can. Outside of that, if you want to ride the wave of AI and get access to this next generation of companies that are private, that are going public, you want to look at some of these private AI companies that are hitting the market. But I do not think it's overvalued. The multiples are stable.
It's such a brave new world when you really think about it. Now private equity has access to the NFL in a way it never did. Now we're hearing about, as we were just talking about with one of our guests prior, the opportunity to invest in college teams.
Yeah.
And programs which never existed before, and expecting some sort of return from that. Is that attractive to you?
Not me specifically, but it is to certain investors. I prefer bond-like risk and private equity-like returns. I consider the college frontiers more emerging, growth stage or early stage. I like the sophisticated leagues that are dominant monopolies and not the areas that are on the fringe, right? But if you are a sophisticated investor and you can look at a stream of cash flow and you can look at the risk associated with the creditors of that stream of cash flow, that revenue, and you can underwrite, I think it's a huge play or a quasi-capital structure arbitrage on the media companies who are paying the media rights. Forget about the colleges. Who are the colleges receiving money from? What type of contracts do they have over a 10-year period? What are the credit worthiness of those particular counterparties? That's what you underwrite. And that's why everyone's excited about this asset class.